In this video, we are breaking down 5 stocks that the top 1% are quietly loading up on while most investors are distracted by headlines, short-term fear, and market noise. By the end of this video, you will understand why these specific businesses continue attracting long-term capital, how their competitive advantages compound over time, and why patient investors see them as core holdings for the next decade and beyond. These companies dominate critical layers of the global economy. They operate at massive scale, control essential infrastructure, and are businesses designed to compound value year after year through durable moats, pricing power, and embedded relevance in how the world actually works. Hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Let's get into the first stock, the trade desk ticker symbol TTD. To understand why the trade desk matters, you first need to understand how advertising money moves in the modern economy. Advertising is no longer about placing static ads in fixed locations. It is about data, automation, measurement, and real-time decision-making across thousands of digital touchpoints. The trade desk sits directly in the center of that system. The trade desk is a demand-side platform, meaning it represents advertisers, not publishers. That distinction is critical. Instead of selling ad space, it helps brands decide where, when, and how to spend their advertising budgets across the open internet. This includes websites, mobile apps, streaming platforms, and connected television. Because the company does not own media inventory, it operates as a neutral partner. Advertisers trust it to optimize outcomes rather than push inventory. This neutrality creates a powerful long-term advantage. Advertisers want transparency, control, and measurable results. As ad budgets become more scrutinized, companies demand platforms that can prove return on investment. The trade desk has spent years building sophisticated measurement tools that allow advertisers to see performance clearly and adjust campaigns in real time. One of the biggest structural shifts benefiting the trade desk is the migration from linear television to connected television. Traditional TV advertising is inefficient. It is difficult to measure, hard to target, and expensive. Connected television brings digital precision to television scale. Advertisers can target specific audiences, track engagement, and optimize spend dynamically. This is not a cyclical trend. It is a permanent evolution in how advertising works. The trade desk has positioned itself as one of the leading platforms in connected television advertising. It works across multiple streaming services and devices, giving advertisers reach without locking them into a single ecosystem. As more consumers shift their viewing habits, ad dollars follow. This creates a long runway for growth that is still in its early stages globally. Another major advantage is how the company has prepared for a privacy-focused future. As third-party cookies disappear, many ad tech firms are struggling to adapt. The trade desk anticipated this shift years in advance. Its unified ID framework allows advertisers to reach audiences while respecting privacy and regulatory requirements. This proactive approach has strengthened relationships with both advertisers and publishers. From a financial perspective, the trade desk operates an asset-light, high-margin business model. It does not require heavy capital expenditures to grow. Revenue scales efficiently, and incremental margins expand as volume increases. The company consistently generates strong free cash flow, giving it the ability to reinvest in technology while maintaining balance sheet flexibility. Even during periods of economic uncertainty, the trade desk has continued to grow faster than the broader digital advertising market. This is a sign of share gains rather than simple market exposure. When advertisers tighten budgets, they concentrate spend on platforms that deliver measurable results. That dynamic benefits the trade desk disproportionately. Management discipline also matters. The company focuses on long-term relationships rather than short-term monetization. It invests heavily in engineering, data infrastructure, and platform improvements. This reinforces its moat and increases switching costs over time. Advertisers integrate deeply into the platform, making it difficult to replace. The reason high-net-worth investors quietly accumulate the trade desk is not because it is cheap or flashy. It is because it sits at the intersection of automation, data, and advertising dollars at global scale. Businesses that enable efficiency across entire industries tend to compound for long periods. The trade desk fits that profile exceptionally well. This is a company built for a world where advertising must be accountable, targeted, and adaptable. As that world becomes the standard, the platform becomes more valuable with each passing year. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move to the second stock on this list, Microsoft, ticker symbol MSFT. To understand why Microsoft remains one of the most heavily accumulated stocks by the top 1%, you have to stop thinking of it as a traditional software company. Microsoft is a foundational layer of the modern digital economy. It is embedded so deeply into how businesses operate that removing it would be operationally disruptive, expensive, and risky. At its core, Microsoft owns the dominant operating system for personal computers worldwide. That alone creates a massive installed base that feeds directly into its productivity software ecosystem. Word, Excel, Outlook, and Teams are not optional tools for most organizations. They are mission-critical infrastructure. Once a company standardizes on these tools, switching becomes highly unlikely due to retraining costs, compatibility risks, and workflow disruption. But the real engine driving Microsoft's long-term growth is its cloud platform. Azure has become one of the most important enterprise cloud ecosystems in the world. What differentiates Azure is not just scale, but integration. Microsoft offers businesses a unified environment where infrastructure, databases, analytics, security, identity management, and productivity tools all work together seamlessly. This integration creates extremely high switching costs. Enterprises are not just renting servers, they are building entire digital operations on top of Microsoft's ecosystem. Once embedded, the cost and risk of migrating away become prohibitive. This gives Microsoft pricing power and long-term revenue visibility that few companies can match. Artificial intelligence is another area where Microsoft holds a strategic advantage. Instead of positioning AI as a standalone product, Microsoft embeds it directly into tools businesses already use every day. This approach increases productivity, justifies premium pricing, and deepens reliance on the platform. AI becomes a feature that improves existing workflows rather than a separate expense line item. Microsoft's enterprise relationships also give it an edge. It already sells to governments, Fortune 500 companies, and small businesses globally. When it introduces new services, it can distribute them instantly through existing contracts and sales channels. This lowers customer acquisition costs and accelerates adoption. From a financial standpoint, Microsoft exemplifies disciplined execution at scale. The company consistently generates enormous free cash flow. Operating margins remain strong even as it invests heavily in growth. Capital expenditures are substantial, but they are strategic, focused on cloud infrastructure and long-term capacity rather than speculative expansion. The balance sheet is exceptionally strong. Microsoft carries manageable debt relative to cash flow, maintains significant liquidity, and returns capital to shareholders through dividends and share buybacks. This combination of growth investment and shareholder returns is rare at this scale. What makes Microsoft particularly attractive to wealthy investors is predictability. Revenue streams are diversified across subscriptions, enterprise contracts, cloud services, and consumer products. No single product cycle determines the company's fate. Instead, Microsoft evolves alongside technology while maintaining its role as a core enterprise partner. This is why institutional capital continues flowing into Microsoft during both bull and bear markets. It is not a trade. It is a long-term compounder built on embedded relevance, switching costs, and financial discipline. Now let's move to the third stock on the list, a company most people barely think about but one that powers much of the digital world behind the scenes. Broadcom, ticker symbol AVGO. Broadcom is one of the most misunderstood companies in technology. It does not sell consumer gadgets. It does not chase trends. Instead, it focuses relentlessly on supplying highly specialized components and software that modern infrastructure simply cannot function without. Broadcom designs and supplies advanced semiconductors used in data centers, networking equipment, broadband access, and wireless infrastructure. These are not interchangeable parts. Broadcom's chips are often custom designed in collaboration with customers and integrated deeply into their systems. Once designed in, they remain there for years. This creates a powerful moat. Customers plan their infrastructure years in advance. Switching suppliers is costly, time-consuming, and risky. Reliability and performance matter more than price in these applications. Broadcom competes where quality, scale, and long-term support are critical. One of Broadcom's greatest strengths is its disciplined market selection. Management avoids low-margin, highly competitive segments and instead focuses on areas where it can command pricing power. This results in strong gross margins and consistent profitability even during industry downturns. Broadcom also operates a significant enterprise software business focused on infrastructure management and security. This segment provides recurring revenue and smooths out cyclicality from hardware demand. The combination of hardware and software cash flows makes the business more resilient than many pure semiconductor companies. Data growth is the core long-term driver here. As cloud computing expands, artificial intelligence workloads increase, and global connectivity improves, demand for high-performance networking and storage infrastructure accelerates. Broadcom supplies the critical components that make this possible. Financially, Broadcom is known for exceptional cash generation. The company converts a large portion of revenue into free cash flow. Management prioritizes returning capital to shareholders through dividends while maintaining flexibility to invest and acquire strategically. The dividend itself has become a major attraction for long-term investors. It has grown consistently, reflecting confidence in cash flow durability. For wealthy investors seeking both income and exposure to technology growth, Broadcom occupies a unique position. What truly sets Broadcom apart is management discipline. The company does not overextend during booms or retreat during busts. It maintains focus on profitability, customer relationships, and long-term value creation. This steady approach appeals strongly to institutional investors who value reliability over hype. Broadcom operates quietly, but its importance continues to grow as the world becomes more data-intensive. It is a company built to benefit from long-term infrastructure expansion rather than short-term consumer cycles. Now let's move to the fourth stock, Amazon, ticker symbol AMZN. Amazon is often reduced to an online retailer in casual investing conversations, but that framing dramatically understates the true scope of the business. Amazon is not simply selling products, it has built a global operating system for commerce, fulfillment, digital services, and cloud computing. That distinction is why long-term capital continues to accumulate shares quietly. At the foundation is Amazon's logistics and fulfillment network. Over many years, Amazon invested aggressively in warehouses, transportation, robotics, and last-mile delivery capabilities. These investments were expensive and hurt short-term profitability, which caused many investors to underestimate the business. In reality, they built an infrastructure advantage that is extremely difficult to replicate. This network allows Amazon to move goods faster, cheaper, and more reliably than competitors. Speed and convenience drive customer loyalty, which in turn drives volume. Higher volume increases efficiency, which lowers per-unit costs. This feedback loop strengthens Amazon's moat over time. E-commerce itself is still growing globally, but Amazon's advantage lies in scale and selection. Third-party sellers rely on Amazon's platform, fulfillment services, and customer base. This creates a marketplace dynamic where Amazon benefits from transactions even when it does not sell the product directly. The more sellers that join, the more valuable the platform becomes for consumers. The most important segment of Amazon, however, is Amazon Web Services. AWS is one of the most profitable and strategically significant cloud platforms in the world. Businesses of all sizes rely on AWS to run applications, store data, and scale operations globally. Once companies build systems on AWS, switching costs become substantial due to complexity and risk. AWS benefits from long-term secular trends including digital transformation, cloud migration, and data growth. These trends are not tied to consumer sentiment. They are driven by efficiency, scalability, and cost optimization. As businesses modernize their operations, cloud infrastructure becomes essential rather than optional. Advertising is another powerful growth engine. Amazon has direct insight into consumer purchasing behavior, which makes its advertising platform uniquely valuable. Brands can advertise at the point of purchase decision, which often delivers higher return on ad spend compared to traditional digital advertising. This segment carries high margins and leverages existing traffic. From a financial perspective, Amazon has entered a new phase. After years of heavy reinvestment, management has shifted focus toward efficiency and profitability. Cost controls have improved, logistics networks have been optimized, and operating margins have expanded. Free cash flow has recovered meaningfully, strengthening the balance sheet. Amazon's ability to self-fund growth while improving profitability is a key reason wealthy investors remain confident. The company does not rely on external capital to execute its strategy. It generates cash internally and allocates it toward initiatives with long-term payoff. What makes Amazon especially compelling over long horizons is optionality. The company operates across commerce, cloud computing, advertising, digital media, and logistics. Each of these businesses benefits from scale and data. Few companies have the ability to cross-leverage infrastructure across so many verticals. The top 1% accumulate Amazon because it is not finished building. It continues to refine, optimize, and expand its ecosystem. Short-term volatility does not change the long-term trajectory of a business that sits at the center of global consumption and digital infrastructure. Now let's move to the fifth and final stock on this list, a company that monetizes information, attention, and data at a scale unmatched by nearly any other business in history. Alphabet ticker symbol. Google Alphabet is best understood as a cash-generating machine with extraordinary optionality. At its core, the company dominates global search. When people want information, they use Google. That habit is deeply ingrained and reinforced daily by billions of interactions. Search advertising remains one of the most profitable business models ever created. Advertisers pay to reach users at the exact moment they express intent. This leads to high conversion rates and strong pricing power. The scale of Google's search engine generates enormous data, which continuously improves relevance and ad targeting. This creates a self-reinforcing moat. More users generate more data. More data improves results. Better results attract more users and advertisers. Breaking this loop is extremely difficult for competitors, regardless of resources. Beyond search, YouTube represents a massive media platform with global reach. YouTube benefits from strong engagement, creator ecosystems, and diversified monetization through advertising, subscriptions, and premium offerings. It continues to grow revenue while expanding margins over time. Cloud computing is another important pillar. Google Cloud has improved operational efficiency and continues gaining traction with enterprise customers. While smaller than competitors, it leverages Alphabet's strengths in data analytics, artificial intelligence, and security. Profitability improvements in this segment add incremental value without requiring dominance. Artificial intelligence is deeply embedded across Alphabet's products. Rather than treating AI as a standalone hype narrative, Alphabet integrates it into search, advertising, cloud services, and productivity tools. This improves user experience and strengthens monetization without disrupting the core business model. Alphabet also maintains a portfolio of long-term projects beyond its core operations. These initiatives provide exposure to emerging technologies while being funded by massive cash flows from the core business. While not all will succeed, the optionality is valuable and largely unpriced by the market. From a financial standpoint, Alphabet is exceptionally strong. It generates enormous free cash flow, holds substantial cash reserves, and carries relatively low debt. This financial flexibility allows the company to invest through economic cycles, repurchase shares, and pursue strategic initiatives without balance sheet stress. What makes Alphabet particularly attractive to long-term investors is the combination of dominance and adaptability. The core search business continues to grow, while newer segments add incremental upside. The company does not need speculative breakthroughs to justify its valuation. It simply needs to continue executing on businesses it already controls. The top 1% favor Alphabet because it monetizes attention and information at global scale. That is a position of enduring power in a digital economy that continues to expand. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Now let me ask you a question. When you compare these 5 businesses, which one do you believe has the most durable competitive advantage over the next 20 years? And which one do you think the market is still underestimating the most today? Share your perspective in the comments and let's get a real discussion going. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.